Why silver matters to California. Silver prices have been moving, and while most people see silver as just another commodity or investment, it has historically acted as an early warning signal for economic stress. Not a headline trigger, not a panic indicator. A signal. Silver tends to react before problems fully show up in everyday life. It reflects inflation anxiety, financial tightening, and stress inside the system. And when those pressures appear, California feels them faster and harder than most states. This video explains how silver prices connect to California housing, insurance, and cost of living, why the impact isn't immediate, and what kind of environment Californians are likely moving into next. This is not about predicting a crash, it's about understanding pressure. Silver behaves differently from most assets. It sits at the intersection of money and the real economy. When silver rises or becomes volatile, it usually reflects one or more of the following: inflation concerns, expectations of prolonged high interest rates, distrust in purchasing power, or anticipation of economic slowdown. Unlike gold, silver is heavily tied to industrial demand. That means when silver moves, it's often responding to expectations about future economic conditions rather than current headlines. Historically, silver tends to move early, long before layoffs spike, long before housing stress becomes visible, long before households fully feel the squeeze. It doesn't tell us when something breaks. It tells us when pressure is building. California amplifies economic signals. Housing costs are already among the highest in the country. Insurance markets are fragile. Utilities, fuel, and food prices sit well above national averages. State and local budgets rely heavily on income taxes and capital gains, which are sensitive to economic slowdowns. So when silver signals inflation stress or tight financial conditions, California doesn't absorb it slowly. It concentrates it. What might feel manageable elsewhere becomes restrictive here. One of the biggest misconceptions is that economic stress always causes housing prices to crash. In California, that's rarely how it plays out. When silver signals tightening conditions, interest rates tend to stay higher for longer. That doesn't immediately collapse prices. Instead, it freezes the market. Buyers step back because monthly payments no longer make sense. Sellers hold firm because they don't want to give up low-rate mortgages. Inventory sits. Sales volume drops. Affordability worsens even without price increases. This is the California housing pattern during stress. Stagnation, not collapse. Homes don't move. Mobility declines. Families delay life decisions. First-time buyers get locked out. Silver doesn't cause this. It warns that this environment is forming. Insurance is often the first place Californians feel real financial pain. When silver signals inflation and cost pressure, rebuilding costs rise. Labor costs rise. Materials rise. Risk pricing tightens. In California, insurers respond by raising premiums, reducing coverage, or exiting markets altogether. This creates a feedback loop. Higher insurance costs reduce affordability. Reduced affordability limits buyer pools. Lenders tighten requirements. Some homes become effectively uninsurable. This is not hypothetical. It's already happening, and silver's movement suggests these pressures are not temporary. As financial pressure builds, consumer behavior changes. Households cut discretionary spending. Service businesses feel it. Hiring slows. Contract work replaces full-time roles. Layoffs arrive quietly, not all at once. California's tech and service-heavy economy reacts early to these shifts. Silver tends to move before these effects become obvious, which is why it's often noticed only in hindsight. It's important to be clear. Silver moving does not mean California is collapsing. It does not predict exact timing. It does not guarantee a housing crash. What it signals is prolonged pressure. An environment where affordability worsens, where mobility declines, where costs rise faster than incomes, where stability feels fragile even without dramatic headlines. If silver remains elevated or volatile, watch for continued insurance tightening, slow housing transaction volumes, persistent affordability issues, and pressure on middle-income households. California tends to feel stress early and relief late. Understanding this signal isn't about fear, it's about awareness. Silver isn't shouting. It's warning.